extremely light. Here we are, MMTs. It's a 60-minute called the Volatility Index. And we were at the high yesterday. We came down and we pounded in that bull rally up. And the lower that we go, that means that everybody is waiting on what? Europe. And everybody feels the good bank, the bad bank, and all the austerity and everything around the world and all the downgrades that are coming. Italy was downgraded after the close. It doesn't matter. We reached a blow-off top. Then yesterday's reversal, and we have come right back down here. We're still elevated at 31. But we are at a major support level, and if we continue to go down, then equities continue to run up off of their 52-week lows on the indexes. For crying out loud. We had buys on the S&P at 1075. Mr. Plain with the 1120 call. That's now at 1138. Up 14.47 handles. Volatility is volatility. Price action volatility for the bears, when you're breaking out, you're really pounding them short. But when you're going down, once again, whether it was at the first 52-week low that everyone remembers back over here and you were going down, stocks were rallying. Well, guess what? From 927 up here until the top of the 1024, you're fading back, and you've got upside bull volatility versus the bear volatility. Even though that it remains high, it's costing less money for people to buy insurance now. The put to call ratio was that the deflated calls had to have a move. And the inflated puts that worked during the cycle needed to come down. And how do you verify it? 2250 on the 505 put that expires Friday at 690. The bear stays too long. Okay? The bear stayed too long. $16 on the 375 put on the high of the day. Closed at 8. Printing at 390. The bear stayed too long. The bear stayed too long. And now, the opposite, because of the fear coming down on this 60-minute, and all day it's telling you that there is no fear in this tape. But you can never confirm any of this until the second day after that rally that we called off the bottom yesterday. We called that rally before the markets opened. We said what it would look like. We said what the key driver would be. Good bank, bad bank in Europe. Oh boy, everything is solved. Hey, this is volatility. Everybody is pent up for some kind of solution, and all it takes is a pop. And the reason why we're coming down like we are in the fear is because everybody thinks there's a great solution. No, there's not. They're going to deal with the earnings, and they're still going to deal with the good bank, bad bank in the 17 countries over there in Europe. Look at, you got Germany, you got Italy is the real one, that if Italy goes bad, ain't nothing going to stop it, and the Greece still forget about it. Everybody feels right now in the last 24-hour period that everything is okay, there's nothing to worry about. But they're wrong. And you people have been here. You have witnessed upside volatility. You can't have just a one-way down. And any little breath of news or any leak that these people are going to guarantee assets in Europe, meaning that the depositors, the population that have money in there, that they're going to have a guarantee that their money is going to be safe. And when you get into the bond thing over there, and all of it is a very, very big mess. And anything that any whiff that they might do the right thing, because they never do, and they will wait till the last day, just like the U.S. did. Don't you remember about bringing the deficit down? They had to wait. So once again, it's a Playhouse 90 show, and a Playhouse 90 show says right now they have no fear, and that they have a resolution. And that was the blow-off top, and we put a blow-off bottom. And in pre-market analysis on 10/4 of year calendar 2011, we said it was time to get net long and then sell into the rally. Get long, sell into the rally. Okay? Once you do get your big pop, it won't matter. Companies forward-looking in the next week or two during the earnings season are going to have to deal with the mess during the reporting session. But right now, it's the upside volatility between the buyer Who has been more fearful? Professionals don't know what to do with the market. You're keeping it up real well. And once again, that is the VIX. And let me make it clear that this was told and transmitted worldwide. Because it was. On 10/4, in pre-market, the transmission went around the world as to what to expect and how blow off top here. And at the very same time, you're going to put the second calendar year low in on the S&P down around 1075, and S&P in one full day, 1075 back to 1136. Will they fail? Absolutely. Because what's that knee jerk of hope and the way that the public is going to act will be once again in the next cycle is short every and any rally for the foreseeable future going into this calendar year and all of 2012. There is nothing that says that any of what they're doing will have any meaningful outcome. It is just good enough for a bull hype move. Take the hype move when they're there. When the fear goes down, the hypes are moving in on low volume upside movement and how to take advantage of it, because no professionals got that low of the market yesterday. We did. And nobody got the low of it today. They're sitting on the sideline waiting. They're not selling. The bear is terrified because as soon as they get that announcement, the bear is going to get squeezed, and the bear is in a short squeeze right now. And it is evident. And it was transmitted around the world by SMF on how a market would put in a bottom and short-term upside volatility, just as you were taught in the summer 10 days up for the failure. And just as you were taught when I was in Big Bear, how you could take that upside and it would fail. And every upside movement will fail. But you will have to wait out the tape, and as the less fear that there is, the easier it is for you to walk that upside of that bull trap.